Hello and welcome to this short video where we walk through solving exercise 9-3B, all about sales tax. So, Tiger Books sells books and other supplies to students in a state where the state tax is 7%. Tiger Books engages in the following transactions for year one. Sales taxes of 7% are collected on all sales. So kind of works like GST in Canada. Everything is taxed 7%. Okie dokie. So here we go with transaction one. So book sales, not including sales tax for year one, amounted to $215,000 cash. So we're going to have three accounts here. The first one being cash, because the cash of the business is going to go up. So that's going to be our debit. I'm just going to figure out our debits and credits first, because we should, and then we'll figure out the dollar figures after we figure out our accounts. So cash is number one. We're also going to have sales tax payable, because we're going to collect sales tax on top of the revenue we get for these books. So it could be sales revenue, but I'm just going to be lazy and put revenue because, well, actually the title of my account is sales revenue, so maybe I shouldn't be quite as lazy. All right. So those are our three accounts. Revenues are always credit, so I know that's going to be a credit. And I know that's the sticker price for all those darn books, so that's our amount of revenue. Now, our sales tax, what we need to charge on top of that, or collect on top of what we're selling for our books, is 7% of this amount. So I'm just going to take that and times it by 7%. Oops, maybe times 7%. Woo! So there's my sales tax amount, and my cash I'm gonna have to get from my customers is a combination of those two. So of course the cash I get is going up by the sales tax and the revenue. So I'm just gonna post these into their T accounts, because that's kind of the important part, is keeping track of all these things in their individual categories. So my sales tax payable is going up on the credit side because it's a liability, and that's just how we add to our liabilities. And then my cash, that's an asset account. So it goes up on the debit side, and life is very good. So we're going to have these exact same accounts for transaction two. And in transaction two, we've got miscellaneous items were $160,000, not including tax. So 160 grand, that's our revenue. The amount before tax, our sales tax is just going to be that amount times the 7%. Woo! All right. And again, our cash just going to be the combination of those two amounts. Okay, we are cooking. So again, we're going to keep track of all this stuff, post them into our T accounts so we can keep track of how much we owe in sales tax and our total revenues and how much cash we have, all very important aspects of our business. Yay! All right, here we go. Transaction three. Cost of goods sold amounted to $195. Oops, I forgot an account. So we're going to have to add it, but that's okay. So I know cost of goods sold is a merchandiser's biggest expense, and expenses are always debited. So 195,000, and I'm going to be taking that out of an inventory account. So we would just have to assume that, we had an inventory account that we subtracted out of with that credit, and my cost of goods sold, boom, there we go, $195,000. Yeah. All right, number four, we're cooking here, we're cooking with gas, because we're going to pay $95,000 in operating expenses for the year. Expenses are always debits, so I am going to debit operating expenses for $95,000. Now, we can assume that we're paying cash because it doesn't say we're paying on account, so cash it is. Baby, woo-woo, and my debits equal my credits. We are cooking. Here we go, operating expenses. Whoop, whoop. Yeah. 95,000 going out the door here. My cash is credited when I pay that amount. All right. Finally, I need to pay that liability. The state is saying, pay up what you owe, yo. So, when my liability is reduced, so when I go to pay off a liability, I need to debit that liability. So I'm going to debit my sales tax payable. Now I'm going to debit it by the total amount that I've collected. So in total, I collected that on the first sale, that on the other sale. So that's the amount that I'm paying off, and I'm going to take that out of my cash. Whoop. Yeah. So again, that's getting subtracted out of cash. This gets subtracted out of my sales tax payable. So if I think about this, love thinking about sales tax payable. So if I total up this liability account, so that all my credits minus my debits, you can see that I no longer owe anything to the government. I've paid everything off in this transaction. All right. So, what is the total amount of sales tax Tiger Books collected and paid for the year? Bada bing bong boo. There it is, $26,250. We prepared the journal entries for the transactions. There they all are. Happy little journal entries. Now, what is Tiger Books' net income for the year? Well, cash. That's an asset not in the calculation for net income. Sales tax payable, liability. That's on my balance sheet. No good for calculating net income. Those income statement accounts, my sales revenue, cost of goods sold, and operating expenses, those are definitely the ones we want for that operating income. So we've got total sales of, we've got sales revenue of $375,000. Then we're going to subtract our expenses, our cost of goods sold, $195,000, and our operating expenses of $95,000 to get our net income, which is a whopping oops. There is the grand total, our net income, $85,000. We are good and done this question. Hope this helps, and have a great day.